There aren't many things that are guaranteed in trading, but these things will guarantee that you blow up. Stay tuned. Hey traders, warm welcome to UK Risk Management's number one on my agenda. If you're subscribed to the channel, appreciate your support, and you know that risk management is so key for longevity in the game, for improvement, for account growth, all the things. However, these 7 things, if you do these, will almost guarantee you will blow up as a trader. Okay, there's not many things in trading in the markets that are guaranteed. There's definitely not a strategy that's guaranteed. But if you do these things, these guarantee that you blow up. Now, obviously, this is a tongue-in-cheek video. So the idea is that we flip them on their heads and we try to do the opposite. Too many times I see traders doing this, and 6 months down the line, they're out of the game. They don't show up to a meeting, they don't do this, they don't do that, you can't speak to them. They disappeared because they've done one or all of these things. In fact, if you do all these things, almost certain that you're going to blow up. 1 or 2 of these things you might get away with for a while, but until you master it, you're vulnerable. Right. Number 1 is trading large size. Now that in itself isn't a problem. If you've got a £1 million account, then trading relatively large size isn't that much of an issue. You've got 100 million, fine. But this is relative to your account size. If you've got a 100 grand account, a 10 grand account, let's say you've got a 10 grand account, and you're trading a position that's got risk of 2,500 odd loss on the stop. So if you lose, or if you get stopped out, you lose 2,500. You won't be in business long enough. It doesn't matter the best strategy you've got in the world. All you need is 4 losers in a row, and you're out of there. And that's not even including the margin requirements you need, etc., etc., etc. So trading a size that's acceptable for your account balance is crucial. Yes, we all want to trade big size because we all want to make the big money in the markets, right? That's why most of us are in the markets. But we've got to measure ourselves and say, okay, my account is only 100,000. I can only trade X amount. My account is only 500,000. My account is only 10,000, 1,000. Whatever it is, it doesn't matter. The order of magnitude is irrelevant. What is relevant is that you're trading the correct size for your account. Now, the textbooks will say you do 1% of your account size. You can adjust that and be a little bit more aggressive as you start to improve if you want to see growth. But bearing in mind that as you start to increase the account size, you increase the probability of blow up. So of course, if you're way at the other, your trade size, should I say, as you're driving your trade size higher, you're also increasing your probability. So it's up to you to decide where you put that. We're all adults here. You can make the decision yourself. You can go all in on one trade if you like, and you could potentially double your account, quadruple your account. You might get lucky, but unfortunately, all you're doing is you're increasing that size, is that you're adding luck as a factor much more. Whereas if your size is small and you're repeating it, then it becomes skill. The casino doesn't put, they know that there's luck involved in every spin, but they know that over 10,000 spins they're going to make the edge. So they don't just allow. That's why they have table limits. They don't let someone come in and say, hey, you know what, I want to stick 500 billion quid on this because it could blow the casino up. They know that that's not the way to do it. So trading large size relative to your account is a surefire way to be out of the game. The second one is trading bigger. Trade bigger after losing. So when you lose, you just trade much bigger because it gets back sooner, right? If you've lost $1,000, £1,000, if you trade bigger on your next trade, then you're going to make that 1,000 back, plus you're going to make 1,000. It makes sense, but it doesn't, because ultimately when we're losing, we are most of the time trading in the wrong manner. So I'm not talking about one loser. In fact, even one loser is not a great thing to be doing at all. But if we're on a losing streak specifically, it's a time when we need to play defensive. We can't be aggressive. Something's not right. If you're on a losing streak and you're losing money, don't put good money after bad, because what this means is that we're trading our biggest when we're trading our poorest. We want to flip that. We want to be trading our smallest when we're trading our poorest, when we're trading our biggest when we're trading our best, right? Capitalize when we're in tune, and then dial back and play defensive when we're out of tune. Number 3, trade as often as possible. There is something to be said for using scalping as a strategy. It's a very specific strategy. It's tricky, it's challenging, but it can work. However, I'm talking about somebody who is just day trading, swing trading, position trading, 3 or 4 days, and they're in one trade. As soon as it closes, they find another. So they wait for that trade to either stop them out or hit their target, and then they go into the next trade straight away. They're not waiting for the setup. They're just constantly having to be in a trade. That is a surefire way of blowing up, guys. It's absolutely guaranteed, because the chances of a setup hitting, a powerful setup hitting, you know, as you come out of a trade, so one has got a perfect exit, the other's got a perfect entry at the same time, it isn't so unlikely. You know, the price that you want to go in at is set up, the filters are there, your trigger is okay if it pulls back to this price. What's the chance of it hitting that price as you exit the other trade? It's not. So trading less frequently, waiting for the sweeter trades is a far better proposition before changing markets. So changing markets frequently. So 1 minute trading oil, next minute trading currencies, next minute trading Apple, next minute trading FAS, which is the financial sector in the US, an ETF, inverse ETF, anything like that. Flipping around from one thing to the other is a surefire way to blow up, because you don't get to feel the nuances of the market. You don't have a specific strategy. Now, one caveat to that is if you've got a strategy that's very specific on a chart basis and you're moving from market to market depending on the chart, that's okay in a roundabout way. I think if you're flipping from kind of crude oil to some gold, or to Apple, or to General Electric, or whatever it may be, you've got to be careful, because the charts and the way they trade are very, very different. If you've got a pool of stocks, say in tech, and you're trading them on a specific strategy, that's fine. But too many times I see people flip from literally one thing extreme to the other, cotton to bonds to this, that, the other, and you think they're completely different animals. They trade in a completely different way. You learn to trade one basket of stuff that's similar. Yes, there are similarities with currencies, similarities with some of the commodities, etc. But the flicking around it just doesn't really work. I don't know anybody who's trading at a high level who just flicks from through multiple different markets. Number 5, don't concern yourself with risk. So if you just go in and you think, you know what, it doesn't matter about the risk. Yeah, it could gap over earnings, but it doesn't matter, it'll be okay. You know that, again, you're putting a lot of your hard-earned capital down to luck. I see people trade over earnings, think, oh, that earnings is going to be good. It's a good company. It's a gamble, guys. It's a complete gamble. Most of the time you're trading over earnings. It's a gamble. Yes, the company may be good. Yes, the company, you might be using it. You see it everywhere, and that might be an okay sign, but the street probably already knows that. It's what they're good, what their guidance is going to be. It's plenty of other things that come into play, not just whether you see them busy in the shop, if it's a consumer product or a retail stock. Number 6, trade on a hunch. This is the big one, isn't it, guys? We see market coming along, we go, you know what, I think that's a long, I think that's a sell, and we just have a hunch. We all have those feelings as when we're looking at a chart, we think that's bullish or bearish. What we don't want to do is stake money just on that hunch, because we want the setup, we want to be able to quantify the risk, we want a decent place to put the stop, we want to evaluate the trade before it comes off over our screen and go, yeah, that's a good buy, and just buying it straight away, and then we're committed. Once we've done that, it's hard to come out of the trade. It's way easier to go into the trade mentally than it is to come out of the trade, for whatever reason that may be. It's easier to pull the trigger, put the order ticket up, go in, than it is to actually exit the trade and come out of the deal. So trading on a hunch is a surefire way, if you do it continually, to getting hammered. Now, there's a caveat with that. I've done a video of how to use intuition as an assistance for trading, but you're not trading purely on a hunch. You're analyzing data based on strategies, etc., etc., and then you're adding that into the mix when you've got enough experience to be able to trust and believe your intuition. All right, number 7, guys, is ignoring trends. Slightly different here, but trends, they carry on for so much longer than you would expect. Even now I look at trends and I think, that's way longer than it should go. At some point that is going to turn, but it could be another multiple years, or depending on what time frame you're looking at, because the trend often continues and will continue without any pullbacks or decent pullbacks for a long, long time. It's the same on an intraday trend even. Sometimes you see these intraday trends and they're running kind of 3 times the usual range of the day, and it's just plodding on. If you're fighting that, you're going to get smashed. It's the same with, swing trading as well. If you're trying to capture end of a trend, and you're ignoring the fact that the trend is strong, you just get run over and run over and run over and run over. Yes, there's a strategy for doing that, and if that's something you're into, then that's fine, but you will have a finely tuned thing that looks for potential end of trends, for signals, for strategies. You won't just be going, oh, that looks like a short, looks like it's gone too high, that's way too high. And it's just, again, you've got the mixture of the hunch and the trend, and that's a combination, recipe for disaster, especially if you're kind of trading big size as well. You know, you end up then losing because you're getting run over by the trend, you're adding to the position, you're doubling up on the position. Before you know it, your account has blown up. So anyway, guys, you do the opposite of these things as a good starting point. If you recognize any of these in yourself, probably I recommend just taking a step back and saying, okay, yeah, you know what? I probably trade too much. I probably trade too much size. I am guilty of trying to get in it back by trading bigger after losing. And if you see that in you, then maybe step back and try and flip it around, because I've never seen anybody who's successful in the markets who's done any of these kind of things. All right, guys, take care. See you next one. Bye.